This week on 9th August, we have 3 impactful webinars. By 10 a.m., we have 2 webinars. Master Wealth Milestone, how to turn financial goals into reality, and Refunding Risk for the Indian HNI, beyond traditional portfolios. Following by 11 a.m., we have NRI Insurance Blueprint, cross-border protection for global Indians. Link given in description. Click the link and join our webinars.
Welcome to this episode of Into the Multiverse, where we are going to be rethinking risk. Now, a lot of investors have some perceptions about what risk is, and they make a lot of their investment decisions based on optimizing how much risk they want to take. Before we can get into what risk is, we should learn something from the investment legends that have come before us. This can help us shape our perceptions of risk and address the kind of investment requirements that we need. And that's exactly what we're going to cover in this video. So the first quote that I'm going to introduce you to is from Bill Miller. He says that the perception of risk is not the same thing as risk. Now, this might sound silly or even simplified, but it's very important to understand it in an investment context. A fixed deposit investor does not think that they're taking any risk. Whereas somebody who has a multi-asset approach or who is an equity investor is very conscious of the risks that they're taking. But this is only the perception of risk. What is the actual risk that's going on? So an investor who chooses to be only in fixed income investments where they're earning an interest is likely to have a more tax inefficient strategy, is likely to lose wealth to inflation, and is unable to actually grow their capital over a period of time. Now, these are risks that are not perceived simply because the returns are steady and predictable. For an investor who has a multi-asset approach, it's likely that their investments are going to grow above the rate of inflation, that they're going to have liquidity as well as preservation of capital in the long run. So when this occurs, the perception and the actual risks are actually different. So an investor needs to know what they see as well as what they don't see when it comes to risk. The second risk that we're going to look at is volatility. According to Peter Bernstein, volatility is a symptom of risk, but is not a risk in and of itself. Volatility may obscure the future, but does not necessarily determine it. Now, when we start thinking about risk in this manner, it actually changes our perception about a few things. The first thing is that a lot of investors tend to focus on beta as a metric for the portfolio. Now, this is considered a volatility measure, but beta doesn't really tell us anything about whether an investor can handle that volatility or not. What we really need to understand as investors is something known as drawdowns. Now, drawdowns tell us that how the portfolio performed when the market itself wasn't doing really well. This essentially shows you how much you can potentially lose in an unfavorable market condition. And drawdowns are a better way for you to understand your risk appetite and also your investment potential. So you want to look at products that have a lower drawdown than the market or a drawdown that is in line with your own risk appetite. So I'm going to quickly share a snapshot of how Sphere performed against its benchmark index as well as a pure equity index like the Nifty 50. There are a couple of other interesting metrics that you can study, specifically upside and downside captures. Now, upside capture tells you how much the portfolio was able to perform when the market moved upwards, and your downside capture tells you how much the portfolio lost when the market was in a bad phase. So knowing these three metrics might help you make a more informed decision. And if you'd like to know how we are doing this at Sphere, then join our webinar this Saturday. The registration link is in the description below. This brings us to our last piece of investment wisdom from Benjamin Graham. This is a long quote and I'm going to read it out to you so that you can get the full impact of what this wisdom has to impart. I don't think the objective of an investment should ever be to take a risk in order to get a return. I think the objective of shrewd investment should be to find opportunities which offer a larger than average return combined with adequate safety. So when we look at a product like Sphere, it's able to achieve all of these objectives simply because it follows a value investing strategy, which essentially means you're trying to minimize the amount of risk, but also get an above average return. We also follow a contrarian investing strategy, which makes your investing more resilient and interesting. The last thing that we do is have a multi-asset approach, which essentially allows you to manage risk effectively, create a more smoother compounding journey, and participate continuously in markets. This sounds like a perfect investment product for you. If you would like to talk to us about how you can take this journey forward, then write to us on WhatsApp at 9500027285. If you want to start investing in Sphere, then the process is fairly simple. There is a link in the description which will allow you to reach out to us and tell us exactly what you want. It takes 2 minutes to fill, and you can click on the link in the description below.